All right, let's just jump right into this. $3.8 trillion. Think about that number for a second. That is the absolute staggering amount of market value that was just added by S&P 500 semiconductor companies in a mere 6 weeks, wrapping up in early May 2026. Just to put that into perspective for us, that is roughly equivalent to the entire GDP of the United Kingdom, literally just materializing out of thin air in less than 2 months. Absolutely wild, right? And naturally, when you see a move of that sheer magnitude, it brings us to the ultimate question on everyone's mind right now. Is this the dot-com bubble all over again? I mean, the semiconductor index just printed its strongest 25-day move since March 9th, 2000. And if you know your market history, you know that date is the literal exact peak of the dot-com bubble right before the massive crash. So yeah, it's a comparison that's making every veteran investor take a very, very deep breath.
So welcome to The Explainer. I am so thrilled to have you here with us. Today, our mission is to cut straight through the hype and demystify this historic surge. We aren't going to rely on speculation here. We're going to look squarely at the actual fundamental data. By the end of this, you are going to understand exactly what's driving this $3.8 trillion chip melt-up, and whether the foundation underneath all of it is solid concrete or, well, just sand. Here is our roadmap for today. First, the magnitude. Second, earnings versus promises. Third, the CapEx engine. Fourth, outlier stories. Fifth, the bear case. And finally, number 6, the benchmarks to watch next. Starting off with Section 1, the magnitude, 6 weeks of vertical moves. To really grasp this rocket ship, you just have to look at the VanEck Semiconductor ETF, which tracks the broader chip sector. It just hit its absolute strongest monthly return on record in April 2026. You see, this historic run wasn't just random. It was a clear chronological chain of massive catalysts. It all kicked off on March 16th, when NVIDIA's CEO Jensen Huang raised their order forecast to a staggering $1 trillion through 2027. Then, exactly a month later, on April 16th, TSMC reported an absolute blowout Q1, pretty much proving they're manufacturing these chips as fast as humanly possible. Then, boom, a week later on April 23rd, Intel jumped 24% in a single day. That's their biggest gain since 1987. And finally, on May 8th, news of a preliminary Apple and Intel manufacturing deal essentially capped off this unprecedented melt-up. All right, moving to Section 2, earnings versus promises, and why this isn't 1999. Because unlike the speculative dot-com era where companies literally just had cool domain names but zero revenue, today's leaders are printing undeniable piles of cold, hard cash. Just look at the stark contrast in valuations here to see the whole this time is different argument in action. Back at the peak of the dot-com bubble in March 2000, Cisco traded at a forward price-to-earnings ratio of about 131 times. Now, compare that to NVIDIA today, right in the middle of this massive melt-up. They're trading at roughly 24 times calendar 2026 forward earnings. So when you look at it relative to its explosive earnings growth, tech is actually cheaper now than we might intuitively think. And honestly, these valuations make total sense when you dig into the raw numbers. The earnings beats across the entire sector were just uniformly massive. NVIDIA booked almost $215.9 billion in revenue. That is up 65% year over year. Micron's revenue, it nearly tripled to $23.86 billion. And TSMC, the foundry actually making all these chips, pulled in $35.9 billion with incredibly healthy gross margins of 66.2%. So the fundamentals anchoring this bull case are, quite frankly, rock solid. Which brings us to Section 3, the CapEx engine, following the money. I mean, someone has to be buying all of these highly profitable chips, right? So we really need to figure out where this revenue is actually coming from. Well, the answer is the hyperscalers. The top 5 tech giants who are building the AI infrastructure of the future are fueling a breathtaking vertical explosion in capital expenditures. Look at this. They went from spending about $256 billion combined in 2024 to $443 billion in 2025 to an estimated $700 billion in 2026. This isn't your normal everyday tech sector scaling. This is utility-level, heavy industry spending, and it is happening almost entirely to build out AI data centers. And when we break down those specific commitments, the sheer scale of the investment is just mind-blowing. Amazon is guiding for over $200 billion. Microsoft is at $190 billion. Alphabet's right there at $175 to $190 billion. Meta is committing $125 to $145 billion. And even Oracle, down there at roughly $50 billion, is showing unbelievable commitment. Now, that $50 billion might seem smaller compared to the others, but Oracle is now spending an astonishing 86% of its total revenue on CapEx. They are literally betting the entire farm on AI infrastructure.
Let's dive into Section 4, Stories Behind the Surge. We're focusing specifically on Intel and SanDisk, two micro-stories that perfectly capture just how quickly the market can rewrite a company's destiny. First up, we have Intel. Now, think about this. Just a year ago, analysts were questioning Intel's very survival. And now, the stock has surged roughly 239% year-to-date. Why the massive turnaround? Well, they secured billions in U.S. government funding, they got direct backing from NVIDIA, and they locked in a preliminary manufacturing deal with Apple. Basically, they've transformed into a strategic geopolitical necessity overnight. But keeping things impartial here, we do have to watch the flip side. They're now trading at a sky-high 128 times forward earnings, meaning the market is pricing in absolute flawless execution from them going forward. Next up is SanDisk, and this is perhaps the cleanest expression of the current AI memory shortage. So they spun off from Western Digital in early 2025 at $32 a share. By May 2026, they hit over $1,400 a share. That's up roughly 558% year-to-date, reaching a $230 billion market cap. Because AI requires massive lightning-fast memory, SanDisk saw its data center business grow by a whopping 645% year-over-year. They transformed practically overnight from a cyclical hardware play into an absolutely essential piece of AI infrastructure. But it's not all sunshine, which leads us to Section 5, the bear case emerging. Cracks in the foundation. Because a rally this aggressive naturally generates immense risks, and prominent investors like Michael Burry are already holding massive put options, betting heavily against this surge. So, what's the first major crack? Concentration risk. Semiconductor stocks now represent roughly 14 to 16% of the entire S&P 500's market capitalization. To put that in context, that is about 11 percentage points larger than the sector's previous peak in 2000. Just 10 tech and chip stocks drove almost 70% of the S&P 500's rally from late March to early May. Think about that. If this single sector catches a cold, the entire broader market is going to the hospital. The second, and honestly perhaps the most complex risk here, is something called circular financing. Now, circular financing is basically when a company invests capital into a customer, who then turns around and uses those specific funds to purchase the investing company's own products. As you can guess, it creates this closed loop of money that can artificially pump up demand numbers. Let's actually map out exactly how this looks in the real world right now. Step 1. NVIDIA commits up to $100 billion to OpenAI. Step 2, OpenAI, flush with all that new cash, signs a massive $300 billion cloud deal with Oracle. Step 3, Oracle suddenly needs to vastly expand its data centers to fulfill that new OpenAI deal. So what do? They go out and buy billions in hardware, directly from NVIDIA. Analysts are heavily flagging this specific money loop as a major risk, because if OpenAI's actual revenue doesn't eventually catch up to these insane costs, this entire interdependent structure could just act like falling dominoes.
And I think this grounding quote from veteran investor Peter Feinberg really reminds us why we need to stay cautious. He's actually profiting from this rally himself, but he told the Wall Street Journal, "The most dangerous words in investing are, 'This time it's different.'" The semiconductor sector is currently priced for utter perfection. Even a minor misstep by a hyperscaler or just a slight delay in a manufacturing node could trigger a really sharp reversal.
Which brings us to our final section, number 6, benchmarks to watch next. Let's talk about the actionable data points. Here are the 4 critical benchmarks you absolutely must monitor moving forward. First, hyperscaler Q3 CapEx updates. If Microsoft, Meta, or Amazon announce even a single major cut to their infrastructure spending, that demand signal breaks. Second, NVIDIA's next earnings print. Specifically, you want to watch if their gross margins compress below 74%. Third, memory pricing data for NAND and HBM. Remember, the valuations for companies like Micron and SanDisk depend heavily on supply staying absolutely tight through 2028. And finally, keep a close eye on the tech-PEG ratio. If it crosses back above 2.5, it means fundamentals are no longer keeping pace with the hype. So, we've seen $3.8 trillion of value created on the promise that AI is going to transform the global economy. The chips are being built, the data centers are powering up, and money is flowing at a scale we have literally never witnessed before. But I want to leave you with this final provocative thought. We know they are spending the trillions to build it, but will the actual real-world AI revenue eventually catch up to justify the cost? That, my friends, is the multi-trillion-dollar question. Keep watching the data, stay curious, and thanks so much for joining me on this explainer.